Citron Capital is making headlines again. Do you guys still remember that crazy GameStop short squeeze back at the start of 2021? Let's take a stroll, enjoy the view, and chat about this report together. Back then, the GameStop thing was an unprecedented retail rebellion in Wall Street history, and it was the biggest disaster in the career of Citron Research founder Andrew Left. Just recently, on February 24th, 2026, Citron dropped another short report, this time on SanDisk. This report sent SanDisk's stock on a wild ride, with the price dropping nearly 8% at one point during the day. This battle wasn't just about money, it was an extreme case where social media hype met financial leverage. Now let's take a closer look at the breakdown of this so-called Battle of Medellin. Back at the end of 2020, GameStop was just a struggling traditional retailer, hit hard by the pandemic with stores closing left and right. Wall Street giants, including Citron and Melvin Capital, saw it as a dead-end industry and started betting heavily against it. But there was a fatal loophole in the market. GameStop's short interest actually soared over 140% of its available shares. This meant that more shares were sold short than actually existed in the market. This incredibly rare liquidity trap was quickly spotted by the sharp-eyed retail investors over on Reddit's Wall Street Bets. In January 2021, retail investors led by Roaring Kitty started flooding the forums with posts. They used deep financial analysis and some pretty fiery language to rally everyone to buy GME, not just for the profit, but to punish the greedy Wall Street firms. As retail buying pushed the stock to around $40, Andrew Left from Citron dropped a video on January 21st, 2021. He was incredibly smug in the video, mockingly stating that GameStop's real value was $20 at most. He even talked trash, calling the retail buyers the suckers at this poker game. He claimed he understood shorting way better than those Redditors and promised to list 5 big reasons why the stock was bound to crash. Citron's mockery completely set the WSB forum on fire. Millions of retail investors went on a buying frenzy, grabbing GME shares like crazy. What was even more lethal was that they bought tons of deep out-of-the-money call options. This move triggered one of the most violent phenomena in financial markets, a double squeeze. First up was the gamma squeeze. Think about it. When retail buys massive calls, the market makers who sold them have to panic buy the actual stock to hedge their own risk. It was like throwing gasoline on a fire, pushing the stock price straight through the roof. Right on its heels was the short squeeze. As the stock rocketed, those short sellers started seeing massive losses in their margin accounts. To avoid total liquidation, Citron and other shorts were forced to buy back shares at sky-high prices just to close their positions. This buying to cover pushed the price even higher, creating a relentless upward spiral that just wouldn't stop. Over the next few days, GME's stock price just took off like a rocket. On the morning of January 28, 2021, the price even touched a staggering high of $483 in pre-market trading. Facing this total madness that had nothing to do with fundamentals and was driven purely by liquidity, Wall Street's risk management models completely fell apart. Andrew Left's Citron Capital finally couldn't take it anymore and was forced to cover their position as the stock soared past $90. After this battle, they walked away with a devastating loss of over 100%. On January 29, 2021, a completely exhausted Left released a 2-minute video announcing a major strategic shift for Citron. He admitted that he had been totally defeated by retail investors in this battle and made a public statement. After publishing short reports for 20 years, Citron Research will no longer publish them. Instead, we will focus on finding high-potential long-term opportunities for retail investors. Just a side note, even though Left eventually went back on his word and started shorting again once things cooled down, at the time, this was seen as a historic moment of a traditional short seller bowing down to the retail era. This storm directly exposed massive loopholes in clearing mechanisms, short interest transparency, and retail investor protection. This forced the SEC and other regulators to roll out a series of deep, long-term reforms that changed the game forever. Let's bring the conversation back to Citron Research's short report on SanDisk. Along with the hedging battles currently happening among Wall Street giants, it really highlights the massive divide in the memory chip market, which is right in the eye of the storm. Citron's short thesis centers on 2 things: a deep respect for macro cycles and a serious worry about shifting competition in the semiconductor industry. Their report is incredibly sharp, hitting right on these 3 major pain points. First off, we've got to look at what SanDisk's old boss is up to. Since splitting off from Western Digital back in 2025, SanDisk's stock price has gone absolutely vertical, soaring over 1,200%. But get this, Western Digital recently dumped a massive amount of SanDisk shares at a huge discount, about 25% below the market price. Citron sees this weird move as the clearest warning yet that the cycle has peaked. I mean, when the former parent company, the one that knows the industry inside and out, decides to cash out early, it's pretty obvious they're just trying to take their profits and run before the floor drops out. The second reason is that the market is currently treating SanDisk like Nvidia, giving it a massive valuation premium. But Citron is being blunt. They say Nvidia has a real, irreplaceable moat, while SanDisk's NAND flash is basically just a cyclical commodity. The current shortage is just a supply mirage caused by short-term yield issues from competitors. Just look back at the industry's history in 2008, 2012, and 2018. Global capacity right now is actually double the peak we saw back in 2018. Once all that massive capacity hits the market, this supply-demand illusion could collapse in a single earnings season. As for the third reason, we've got to talk about Samsung. They're veteran players in the long-term semiconductor war. They're famous for using their massive capacity and pricing power to aggressively snatch up market share. The report points out that Samsung recently talked tough, saying they won't even touch products with a gross margin below 50%. What's even scarier is they've already started pushing their most advanced chips straight into the high-end enterprise SSD market, SanDisk's home turf. Samsung is basically using its sheer scale and tech wall to swallow up SanDisk's most profitable, high-end customer base. Facing Citron's sudden attack and a potential cycle peak, other institutions didn't just panic and run. There was no one-sided fear. The options and spot markets are seeing crazy capital flows right now. It's basically a massive, complex meat grinder for longs and shorts. Even before Citron went public with their short thesis, SanDisk's short interest had already climbed to about 7.5% of the float because of that irrational price surge. At that point, shorts were sitting on over $3 billion in paper losses. It must have been nerve-wracking. Those hedge funds were worried, what if AI infrastructure demand gives the stock another shot of adrenaline and sends it mooning again? So, they were forced to load up on deep out-of-the-money call options as a last line of defense to keep themselves from getting liquidated. Even with the massive wave of short-selling noise, options chain data shows the bulls are still very much alive. Call option premiums still account for nearly 67% of the total. However, the seasoned institutional money has largely shifted into bull call spread strategies. Basically, they're buying calls with a strike price of $637.5, while simultaneously selling calls at $670. This strategy lets them keep riding the data center boom while recouping some costs by selling high-level options, effectively hedging against high-altitude volatility. Given how volatile memory chips are, some asset managers holding SanDisk long-term are setting up put spreads expiring in March 2026. For example, they're selling $640 puts and buying $610 puts. This highlights a market consensus. Even if you're bullish on memory sector earnings long-term, you still have to buckle up with derivatives to protect a fragile portfolio against historic highs and big-name short attacks. All in all, this is a textbook battle packed with industry cycles, market share wars, and big capital gambles. On one side, the shorts are betting that the cycle will inevitably turn and that a giant like Samsung will crush the competition. On the other side, institutional bulls are busy using complex options to carve out controlled profits amidst all this macro uncertainty. So, we'll just have to wait and see. Will Citron's short on SanDisk turn into another total disaster like the GameStop fiasco? After all, SanDisk is sitting right in the sweet spot of the AI boom, and its momentum is absolutely massive. Or will things actually play out according to his report and lead to a total victory for Citron?